That latest jobs report, what a stunner. It shows the U.S. adding a greater than expected 224,000 jobs last month. Now, the report shows solid employment right across most major industries, I would say save for retail there. Job gains for April and May, though, were revised slightly lower. Now, in the meantime, this is what's key here. The unemployment rate ticked up to 3.7%. That was from 3.6%. And wage growth was tepid, which we'll discuss because that means the Fed may not be on tap in terms of trying to tamp down inflation. Now, futures, however, are pointing to a lower open for stocks right across the board after this report. And I'll tell you why. It is because they are wondering if that Fed will stay on the sidelines for July instead of having to move. This means that all the major U.S. averages are set to pull back. Remember, we were at record highs on thin volume on Wednesday. Now, investors snapped up both stocks and bonds on the hopes that the Fed will begin cutting rates this month. As we're saying, this puts all of that into question. Will it tempt enthusiasts to stay there even at these very high evaluations, or will they decide that the Fed is absolutely not going to move in July? The jobs report, of course, our major driver for today. Paul LaMonica watching all of this. And Paul, I like when you break this down because you are looking at the big number, but you're also looking at the numbers behind that major number. Any surprises there for you?
I think the big surprise is the nice rebound that we had, Paula, in jobs growth after, tepid numbers for May, which really led a lot of people to believe that the Fed would cut interest rates definitely in July. It was a slam dunk, or so we thought. And not only that, but maybe they would even go as far as a half-point rate cut. I think now that is in question. I still believe the Fed probably will lower rates at the end of the month by a quarter of a point because there still are other concerns for the global economy, trade tensions, which haven't completely gone away. Other data looks like it is starting to soften a little bit in manufacturing and housing. So I think the Fed can justify a quarter-point cut, essentially taking back the one they did last December, which a lot of people think might have been too aggressive. But after that, I think all bets are off with regards to how much more the Fed needs to cut rates in an economy, at least from the labor market, that still looks pretty solid.
Yeah, I find it fascinating that the market was able to talk itself into the fact they might even go down 50 basis points. But here we are. Paul, likely they will go in with that quarter rate cut, but some people still here unsure. Paul LaMonica there breaking down those numbers for us. If you're the Fed, you're a central banker looking at this jobs number right now. This is a Fed, remember, that says it is data dependent. What is the Fed thinking?
I think this is a really strong number. I think it's tough in the face of this number to justify a cut. Now, the one caveat to that would be if you look out and think, all right, this is a great report, but we're looking probably at the next one or two jobs report being a bit weaker. We're looking at a lot of data suggesting that the second half of the year could be weaker. You could potentially argue for a kind of insurance cut to keep the markets high. That's certainly what President Trump and his advisors would like, but it's going to be very political. Paula. I mean, the Fed is in such a tough position. There's this dichotomy between Wall Street and Main Street. You see that today with, great jobs report, and yet the markets are falling because they're worried about a rate hike.
Yeah, and I think at this point, many people had spoken about the central bank having raised rates and that maybe that was a mistake. This is a very strong number now. Rana, I don't have to remind you, we are at a record expansion point for the U.S. economy. It just keeps chugging away. We're in record territory this month. And yet a recent survey of CFOs said that almost half of them expect a recession in 2020. Why? What are they seeing in the data?
Well, just earlier, you put up that chart showing that inverted bond curve, right? Long rates and short rates are moving in a way that historically would suggest recession. I mean, all the data points to this. Also, we should say that not only is this an incredibly long recovery, it's the longest in recorded history since something like 1847. When they started keeping records. So you got to think that what goes up at some stage is going to come down. Now, the president is going to try to do everything he can. I mean, you see Peter Navarro, his trade advisor, going on and saying we got to keep rates low. He's going to want to try and keep those markets juiced, I think artificially, until the election in 2020. But we'll see. I mean, we have a record amount of bond debt out there. We still have a very difficult geopolitical situation out there in the world. I do not think the president's quote-unquote deal with China is really going to fix the U.S.-China problem. So a lot of risk factors still.
A lot of risk factors. And Rana, before I let you go, one of them is, of course, Europe. Today as well, I just want to talk about it. We had manufacturing in Germany still looking quite weak. What's interesting here, again, we have to remind everybody, we have negative yields in Germany on their treasury bills. The issue here, though, Rana, is we've got perhaps Christine Lagarde, again, coming in, perhaps as a central banker for Europe. What can monetary policy do when fiscal policy, both in the United States and Europe, looks like it's really hamstrung right now?
You know, that is the $64 million question. I don't think it can do a lot, to be honest. You know, my last book was about this topic. I think we've had actually 40 years of monetary policy sort of papering over various problems in the Western world and developed economies. And I think that we're really at an end of what can do. I mean, you see that every time central banks try and put a little more kerosene on the fire, the markets don't respond as well as they used to in the past. Now, that said, I would say that I think Europe is fundamentally a little stronger than people think. I mean, you do see banks still lending to corporations. You see consumer sentiment in some economies being stronger. So I'm not worried Europe's about to fall off a cliff, but I don't think there's a lot more that central bankers can do for the global economy.